Well, thank you very much. Can you all see my slides? Yep, all good. Excellent. So thank you, Brent, thank you, Jesse, thank you, Matteo, for organizing this. Thank you, Matteo, for the introduction. You already gave a lot of really good ideas for research. So what I'm going to do now is build on what Hanno did. Hanno gave you this amazing presentation of the whole research that you can summarize in just one equation, so give you a way to think about exchange rates. And I'm going to be pedestrian compared to that. But before I just go to the data and tell you how to do things, I want to say two things about why we should spend some time on exchange rates, right? If you think about it, I think you could make the case that it's the most important price in each country. Think about what is clearing both the goods market and import and export, what is clearing the asset markets. Right? Think about the foreign assets and liabilities, how big they are. Matteo gave you some amazing data this morning already. And the currency markets, if you don't want to think in terms of trade, think about it just in terms of turnover, if you want. It's a huge turnover. You've all seen this number, about $6 trillion a day. That's much, much bigger than the equity markets. I can just show you over time. This is not something new. The currency market is 18 times bigger than the equity market. It's not something from last year. So it's a big thing to understand. And here's the thing. It's not like we understand everything. I really like the question on the R square during the break, because it forces us to realize that a big chunk of the exchange rate variation we just don't get, we don't understand. And what we see in this field, we see a lot of puzzling facts, puzzling in the sense of comparing the facts to the models. It's not so easy to make sense of the facts. And so you can see this in a kind of a depressing way. Wow, we don't understand anything. I see it in a very positive way. It means that there are a lot of open questions, there are a lot of research opportunities, a lot of things to understand. So we're talking about something that is really, really big, where our understanding is limited. So that's actually a perfect field to be in. Now, I need to warn you, I only have a limited amount of time, and I'm going to talk mostly about data, about how to do stuff in practice. So there are a lot of things that I'm not going to talk about that are actually relevant for international finance and exchange rates in particular. And so I have to apologize. It's going to be a very limited tour. But still, let's go for the tour. So Hanno gave you this overview of the exchange rate determinants, thinking in terms of the link with the short-term interest rates, the long-term interest rates, and the convenience yields and balance sheet constraints. I'm going to focus on one point, which is how currency returns can be understood, can be thought as a sign of aggregate risk being priced in the currency markets. And so I'm going to walk you through this this reasoning and a lot of research that we've done over the last 15 years. And if you want to think about the organization of this session, I'm going to talk about FX returns with risk. And then Wangxin is going to come. She's going to show you FX returns without risk. That's of course much more exciting. But let's start with the basics, the FX returns with risk. So I'll do the same thing as Hanno did. I'll start from this accounting benchmark, the present value equation, going back to Campbell-Shiver if you want. The only thing you have to do is to define what is a currency excess return. So just to introduce my notation, look at what I have on the screen. I'm thinking about a US investor borrowing at a risk-free rate IT. This US investor, he or she is going to lend at the foreign risk-free rate I star. And the problem is that there is an exchange rate. So if I borrow for 1 month and I lend for 1 month, I know exactly the exchange rate today, but I don't know what it is at the end of the month. And so if the foreign currency appreciates when my money is there, that's pretty good. My excess return is higher. But if the foreign currency depreciates, that's pretty bad. I'm losing money on the trade. So if you iterate forward this equation, as Hanno showed you, you can have this present value definition of the exchange rate that depends on future interest rates and risk premia. And the thing is that for a long time, nobody thought that there was any risk premium in currency markets. It was just like, no, I was not part of international econ or international macro. And so it was all about the link between interest rates and exchange rates. Now, something that Matteo told you during the break, if you try to regress exchange rates on interest rates, you get nothing. Interest rates explain very, very little of exchange rates. So we need to look at something else. And so what I'm going to look at was kind of risk premium. Now, why nobody really thought about this or actually could find much? It's actually has a super long history. It's not the place. I don't have the time to give you the whole story, but it's a story that actually starts in Boston, where this guy, Douglas, is the first, at least the first I know, who proposed this idea of this uncovered interest rate parity. And at first, it looks like pretty reasonable. I'm going to say it not in the terms of 18th century economics, but just as of today. Think about it. Let's say the interest rate in the US is 1%. Let's say it's 3% in the UK. Why don't you borrow in the US at 1 in order to lend at 3? It seems like a pretty cool thing to do, right? And you can do it with billions of dollars, so you should all be rich by the end of the afternoon. Well, you don't do it because you expect the pound to depreciate. By how much? Well, exactly the interest rate difference. So that if you borrow at 1, you lend at 3, but you lose 2% on the exchange rate, and it's not worth it. And if it's not worth it, you don't do it. And if you don't do it, you couldn't have this interest rates difference that persists. Instead, if everybody starts borrowing in the US, the interest rate should go up. If everybody starts lending in the UK, the interest rate there should go down. So if we see interest rate differences that are persistent, it must be that people expect the exchange rates to depreciate by this interest rate difference. And so that sounds super cool, relatively reasonable. Of course, it's not, but that I'm going to show you in a second. It took us humankind, something like 250 years to find a way to test this idea. And you have to introduce rational expectations. And then it's a first paper, it's the first one to run this regression is Adrien, working at the Fed, regressing the change in exchange rates on the interest rate difference. You do this regression, UIP tells you that the slope coefficient should be 1. You can do it the way you want. This regression never gives you 1. The slope coefficient is usually negative, the R-square is around 0. And somehow the field of international finance has run this regression over and over and over again for something like 30 years. And you have more than 300 publications who are basically telling you that the slope coefficient is negative. Now, so that's not super enthusiastic. And so what I would like to is make sure that you're never going to run this regression again. So let me show you the data in a very simple form. If UIP was correct, the change in exchange rates that you would expect would be the interest rate difference. So what would be the actual change in exchange rate? Well, it would be the one that you expect plus some noise. So I took the volatility of exchange rate and I built those fake exchange rates changes that would correspond to the UIP regression. And this is what I'm showing you on this slide. This is the way the world should look like if UIP was a correct description of the world, if Douglas was right, okay? Here, every color is a country, every point is 1 month, a change on the exchange rate over 1 month, or an interest rate difference over 1 month. So that's fake data. That's actually a lot of macro models in the 80s and 90s and up to for more recently are based on that, and this is not true. Let me show you now the truth. This is the truth. I mean, you can see the difference. This is the theory, this is the truth. So clearly UIP it's not even a right starting point. It actually makes 0 sense. 0 sense. I think we just lost way too much time thinking about that. Now, the second thing that you can take out of this graph is that there's not much to see, right? If you see any pattern, well, don't say it, just trade, right? There's nothing, there's no pattern. And that's about the cross-section of exchange rates if you want. And I could make pretty much the same point if I were to look at the time series of exchange rates. And that goes back to the question that was asked during the break. I'm showing you here the change in exchange rates on 3 currencies. And the truth is that I don't remember which currencies I picked. I think I picked the pound and maybe the euro versus the US dollar, but I'm not totally sure. And I'm actually absolutely sure that one of them is just me playing with random numbers on MATLAB. And you can't tell me which one is which. And I can't tell you either because I did that too long ago. And the point is that, yeah, it looks random, but it's not random. And so what I want to convince you in this short session is that exchange rates are not random. And all the reasonings that Hanno showed you before, yes, we can find those in the data. There is hope. It's not because it's difficult, it's not possible. It's there. So how are we going to do this? Well, we need to, in some sense, rephrase a little bit the question. We're not going to be really able to predict exchange rates on a daily basis, on a monthly basis very precisely. We're not going to be able maybe to understand every bilateral exchange rates, but we can still find some clear systematic movements in exchange rates. So I'm going to show you how to do this. And of course, at some point, I'm going to stop, right? Don't worry. I'm going to stop twice. And as Matteo and Brent reminded us, when I stop and we ask questions, we're not recorded anymore. Okay. So how do we try to see something in the data, knowing that those UIP regressions didn't give us much? Well, I think the way to see something is to realize that UIP is just an assumption about risk neutrality. When you say that the UIP is the way you close your model, you're basically saying that the investors are risk neutral. You're saying that the expected excess return is zero. And by the way, you can express this in nominal or in real variables. It's pretty much the same, because of course you can think about the nominal interest rates as the real plus the expected inflation. And the real exchange rate is also going to have those two inflation components. So if you think about the UIP regression, the fact that we find a slope coefficient beta that is not 1, but is actually usually negative, this just means that the expected excess returns is time varying. And the interest rate difference should be one of the drivers of those expected excess return. There's nothing that says it should be the only one, but at least since you've run this regression 300 times, you know that there could be some information in interest rates. So how are we going to use this information? Well, that's the thing we did with Hanno some time ago now, is to switch from a time series study of the exchange rates currency by currency to a cross-sectional study of exchange rates where we build portfolios of currencies. There's a really cool paper by Hassan and Mano in the QG that shows you exactly how to go from the time series to the cross-sectional evidence. Here, I'm just going to show you how to do it in practice. So once you say you want to build some currency portfolios, okay, that's all cool. Of course, it's only a new idea only for currencies, because people have been building portfolios of equity and bond returns for decades, right? Think about the work of Fama and French. They sort stocks according to the book to market. They sort stocks according to the size of the firm and so on. So we can do the same thing for currencies. There are many reasons actually not to do it. I'll also discuss that in a second. So if you want to build currency portfolios, you have to deal with the first basic set of questions. And I said I was going to be pedestrian, so let me go for it. You need to pick a sample of countries, okay? And you need to pick a time window. Where do you stop? Where do you start? How many countries should you have? How many years should you have? There's no theorem here, nothing. I think one way to think about it is to ask the following questions. Can foreign investors buy risk-free notes there? And why do I ask you this question? Then think about what Hanno showed you. He started with simple Euler equations. If you want this Euler equation to hold, you need the foreign investor to be able to buy. So that would be the first thing. Now, as soon as you realize this, you know, ooh, that means I need to think about capital controls, just to see if you can already invest there. You need to think about default risk. These are difficult questions, right? There's a lot of papers just on measuring those different things. So we're going to need to take a stand on that. Okay, let's imagine we've done this and we found a set of countries where we can invest, and we found a set of risk-free notes, things like treasury bills instruments. Now we're getting into the ways of thinking. How many portfolios are we going to build? How are we going to allocate countries into those portfolios. And here it's cool because you can think about all this literature on stocks, on the stocks and bond markets. They had to deal with the same issues, except that it was much easier for them. There's a simple reason why nobody had done this on currency markets. Think about the number of countries you have. If you can find 100 countries to invest in, that's already a big thing, right? I can find 500 firms in less than 30 minutes. And so from the start, from the get-go, it looks like there's this very small number of countries you can invest in. And the logic of a portfolio, of course, is to hope that all the idiosyncratic shocks are going to average out in a portfolio. If I can form a portfolio of 50 firms, yeah, maybe the law of large numbers is going to kick in. If I go on and form a portfolio of 6 countries, is the law of large number going to kick in? It's not so obvious, right? But it's going to kick in. I'm going to show you that in a second. But clearly, when we think about the number of portfolios and how to allocate countries or assets into portfolios, that's what we have in mind. We have in mind this trade-off between the idiosyncratic risk being averaged out and the power of any kind of cross-section we want to build. If you have only 2 points, you can fit a line. If you want some power in any kind of an econometric test, you need many more points. And the points here are going to be the portfolios. So if you have many portfolios, maybe you're going to have some power when you run your asset pricing test. But of course, you're going to have very few countries in each portfolio. And again, here, there's no theorem. And actually, you could use some more work here on thinking about what is the optimal way to build portfolios. There's also things to learn from the work of Adrien, for example, on that. Now, what did we do? Well, at first, I'm going to show you different phases of our work, but we started with the largest data set we could build, looking at many, many countries, taking into account capital controls, default risk, and trying to, in some sense, build as many portfolios as possible. And then I'll show you that this was really very difficult, and there's maybe a much easier way to do this. I could just mention a tiny detail is that we made at some point this choices that I think has been replicated since, to have more countries in the last portfolio. Because think about it, you want to buy you want to build, 5 currency portfolios, you have 26 countries, you don't have 5 countries per portfolio. So where do you put the residual number of countries? Well, let's put them in the last one. Why? Why not? It's just, if you hope that this is where the information is, you want the idiosyncratic risk to average out more there. But this is very fuzzy, of course. Okay. And then there are questions like weighting. How should you weight currencies? How should you weight countries? If you're influenced by the literature in international macro, you're going to think about trade. Maybe if you're more international finance, you want to think about the international flows, the capital flows. Honestly, we didn't know how to think about that. So what I'm going to show you are just equally weighted portfolios. But here, these are open questions, right? So I'll show you first the first thing we did with Hanno when we built this large sample of countries starting in 1953. And for the first time, we built currency excess returns in those portfolios. And so the currency excess returns, just to repeat myself here, think about a US investor borrowing at a risk-free rate in the US, say a treasury bill. You borrow, say, for 3 months, and then you're going to lend your money, convert those dollars into some foreign currencies. You lend this money for 3 months in a foreign country. This defines a currency excess returns. The only source of risk here is the change in exchange rates. So if you can study something about this excess return, you know that you're studying something about the currency risk, because everything else is known, right? And what I'm showing you here in 2 panels are the average excess return annualized over those 2 sample, and then the Sharpe ratios. And what you can see is that there's a clear pattern. The first portfolio has the low interest rate countries, the last portfolio has the high interest rate countries, and the currency excess returns on average tend to increase from low to high. And so that was the first result. The thing to note here is actually it doesn't prove much, because it could totally be that exchange rates are still completely random, and the only thing you're picking up here is the interest rate difference. So this result that I'm showing you here could be totally mechanical. in the first portfolio, you put low interest rate countries. In the last portfolio, you put high interest rate countries. Maybe what you have is just the interest rate difference. It turns out it's not the case. And this difference of average excess return can really be thought as just a sign of compensation for risk. So how could it be a compensation for risk? Well, clearly in the last portfolio, if I invest there, I make money on average. I borrow in the US, I always invest in the high interest rate currencies. I make money on average. If I make money on average, it must be that I'm taking on some risk. So what has to be the risk? It has to be that those high interest rate currencies are going to depreciate in bad times. I'm the US investor. What is a way to define bad times? Well, you could start with consumption. When consumption growth is low, these are pretty bad times. So are you going to lose money in bad times by investing in high interest rate currencies? The answer is yes. You can do some simple OLS regressions, and you're going to just show that. I actually don't need to talk about that too much, but just you should know that really the most basic consumption-based asset pricing view of exchange rate, it sort of works. I'm not saying that consumption growth is going to explain much, but come on, it sort of works. And that's already, here you already see a big change compared to what we were discussing, for example, during the break. Matteo mentioned that when you regress exchange rates on consumption growth or any other macro variable, you get nothing. So the unconditional variation between exchange rates and consumption growth is zero. But conditioning on interest rate, it's not zero. So let me say it again. The logic of those asset pricing regressions are very simple. In bad times in the US investors are going to lose money by investing in high interest rate currencies. And it's the opposite for low interest rate currencies. If you invest in low interest rate currencies, so you borrow in the US and you tend to invest in currencies like Japan, Japanese yen, or the Swiss francs, on average, you lose money. Why do you lose money? Because in bad times, you're going to make money. Those low interest rate currencies are going to appreciate. Okay, so the basic, really consumption-based asset pricing is not such a bad starting point, but we can go much further than that. And I think the way now that a lot of people form currency portfolios and extract information from currency markets is not by looking at the annual frequency and looking at the relationship with consumption growth. It's by looking at much higher frequency data, and I'm going to show you the monthly data. And instead of trying to think about what I mentioned, whether investors can really invest there, whether there's some risk, some default risk or not, people now rely on simple forward and spot exchange rates, and I'm going to show you in a second. But the logic is still the same. The logic is still that if I just look at one bilateral exchange rate, say the pound versus the US dollar, and I try to link that to anything, I don't see it. I don't see it. It's just there's too much noise, if you want. Think about this change in exchange rate as being driven partly by systematic shocks, but also by a lot of idiosyncratic shocks. And that's just too much noise to extract anything. So forming currency portfolios is going to be a way to average out, in some sense, those idiosyncratic shocks and see something in exchange rates, see something. It's not random. So what I'm going to show you now again is the same experiment where you sort countries on the level of interest rates, but you do it every month. And every month you get a new sorting, so you're going to rebalance your portfolio. And you're going to think about the same object. I'm still talking about one object, the one that showed up in Hanno's presentation, a currency excess return. I borrow in the US, I invest in a foreign country for 1 month. The only source of risk is a change in exchange rate over this month. Now, here's the good news. Everything I'm going to show you now, you have it. You have it, and you have both the data and the MATLAB programs. Okay? So let me explain what we are sharing today. So we're going to define the currency excess returns using a forward rate. So Wang-Xin is going to talk to you about forward rate much better than I could. So let me just remind you what a forward contract is, right? I sign a contract today that says that I will be able to exchange some foreign currency for some dollars at the end of the month. So I sign today, but nothing happens today. Everything is going to happen at the end of the month. So that's also a way to think about a currency investment. Sign this contract, don't do anything, wait until the end of the month. In the end of the month, you're going to receive some foreign currency. You need to convert this into dollars at the end of the month, but you don't know what's going to be the exchange rate at the end of the month. Wait and see what's going to be your return, the difference between the forward rate that you signed today and the spot exchange rate that's going to happen at the end of the month. And that's the first equation I have here on this slide. Now, you know that you can rewrite this equation by just subtracting the spot exchange rate today and adding it up. And what you see is that you have this forward spot difference minus the change in exchange rates. So if corporate interest rate parity holds, and that's what Wenxin is going to talk about, you have another way to just compute a currency excess returns. And there's no magic here. There's still only one source of risk, which is the value of the exchange rates at the end of the month. So why would you do would you do something like this? Well, it actually addresses a lot of the questions that we had to deal with before. Can you really invest in this country or not? You don't care about this anymore. You can buy this forward contract. Some forward contracts are called deliverable versus non-deliverable. You can even ignore that. Is there someone somewhere willing to sign this forward contract with you? That's it. That's all you want to know. And you're going to define the exchange rate, the currency excess return very easily. The nice thing you're going to be able to do now too is to take into account the transaction costs that were actually much more difficult to compute before. Now, there are some advantages. There must be some disadvantages too. You're going to have a much more limited sample. So if you're already worried that we look strange compared to the equity literature because we have only a few countries, you're going to even fewer countries here because it's not the case that forward contracts exist on every country. And the second, of course, issue now is that the CIP doesn't hold after the financial crisis. So it's a very nice point that Hanno made, that now because the CIP doesn't hold, it turns out that actually the currency excess returns, the carry trade that I'm going to describe, is even more profitable on forward markets than on cash markets. But more on that later when Wenxin will talk about that. So let me just explain what we posted and what we're sharing today. We're sharing data requests that actually pull data from data stream from two big suppliers, Barclays, because that's the way to start in 1983, and Reuters, because that's actually the largest set and kind of the benchmark, starting in 1988. And we have the spot and the forward series updated to last week at the daily frequency. So from that, we have code, and we're showing you codes to build a data set, just importing this data, cleaning up a little bit, because as any data source, there are some strange values from time to time. So we have this cleaning procedure. You can just read the MATLAB code. And same thing for equity returns, so large set of countries, all the MSCI equity returns and a bunch of interest rates. And with this raw material, the code is going to do what I just described before. It's going to import all that and build those currency portfolios, compute the currency excess returns from the perspective of US investors, and run a bunch of simple asset pricing experiments. Okay, so all that, Matteo and Stacy organize everything. It's on a web page. You're going to find everything. So what I'm going to show you is basically the results, but you're going to be able, of course, to run it yourself. And I hope it's going to help you do much more, of course, than what I'm just showing you today. Okay, so what am I showing you here? I'm showing you the portfolios of excess returns, the way we found them the first time with Hanno and Nick in this RFS paper. And the first panel is just the average excess return. So you see the same message again. The first portfolio has low interest rate currencies. The last portfolio has high interest rate currencies. What you see is a clear cross-section of currency excess returns, from negative in the first portfolio to positive in the last portfolio, from minus 1.5 to 7.7. So again, this could just be interest rates, but no, it's much more than that. It's about what's going on with exchange rates. And so there are two ways to show you that those excess returns are compensation for risk, and thus risk premia are there, exist in currency markets. The first way to do it is in panel 2. Think about, you remember FAMA in French? They sort firms on the basis of their book to market, on the basis of their size. They obtain, again, exactly as we are showing you here, a cross-section of equity excess return, not currency in their cases. And what do they do next? Next, they want to show that those excess returns correspond to covariances between the returns and some risk factors. But they don't know what the risk factors are. So they use the returns themselves to build a risk factor. So Pharma and French look at the high book to market, the return on high book to market firms minus the return on low book to market firms. And they say this is HML. They look at the return on small firms minus the return on big firms. And they say this is SMB. That's going to be a proxy for risk in equity markets. We're going to do the same thing here. So we're going to look at the return on the last portfolio minus the return on the first portfolio. And then we're going to call it HML, just as they did. Okay, high minus low, high interest rate currencies minus low interest rate currencies. And what you can do, so you can run a simple OLS regression of the currency excess returns, or even the exchange rate component if you want, on this HML factor. And what you see is in panel 2 are clear differences in betas, from low to high betas. That's already a sign of a risk premia. Right? You can explain an average excess return as a covariance between the return and the risk factor. But you may say, well, that's just still explaining returns with returns, and there's not much of a distance between your proxy for risk and what you're trying to explain. So let me show you what I think is actually even more convincing experiment. Let's build now a risk factor without using any exchange rates. So the way we're going to do this, we're just going to look at volatility on equity markets with this idea that when volatility is high, maybe you can talk about uncertainty. When volatility is high, these are pretty bad times. But we want to build a risk factor based on volatility without using exchange rates. So look at the equity returns in many different countries, the same countries actually in a sample for exchange rates, but you measure the equity returns in local currency. Right? No exchange rates. You compute the realized volatility, take the average over all the countries. Now you want to talk about shocks, so let's look at the change in volatilities. And let's do the same experiment again. Let's see in a simple OLS regression, what is the beta of each portfolio return on this measure of aggregate volatility. And that's what you see in panel 3. From 0.19 to minus 0.42. So what does this number mean? Well, it means that there's a very different amount of risk in the first portfolio and the last one, and in between you have this cross section. So let me explain the sign. The sign is exactly what you would expect. In times when volatility spikes, shoots up, these are really bad times. You're going to lose money by investing in high interest rate currencies. And why are you going to lose money? Because those high interest rate currencies are going to depreciate. But what's going to happen with the low interest rate currencies? Exactly the opposite. You're going to make money if you invested in low interest rate currencies because those currencies are going to appreciate. And again, the measure of bad times here are just spikes in global volatility, not something that uses any exchange rate. It's just a measure of risk. It's not maybe the classic ones, maybe the first one we could have tried, but others have tried some that could work too. Matteo, for example, has shown that measures of downside risk on equity markets do a pretty good job also at explaining the same currency portfolios, right? But here, what I want to show you is that we can use the simple logic of an Euler equation. You make money on average by investing in a risky asset. Why? Because you're going to lose money in bad times. This simple logic applies to the currency markets. Exchange rates are not random. It's something I'm going to repeat many times. So here I'm showing you the classic 45-degree line asset pricing graph. On the vertical axis, I have the actual mean excess return, the exact same data I just showed you. And on the horizontal axis, I have the predicted mean excess return, which is again the product of a quantity of risk, a beta, times a price of risk that you can estimate. And you can even just take the average excess return when you use HML, and it works pretty well. Like, it's not perfect, there are some pricing errors, but it works. There's a clear thing. If things were random, you would not see something like this, and you have the same result on a larger sample of developed and emerging countries. again, you have now all the data to redo this graph, and of course, not just do that, that will be boring, but use the same methodology to find more. Okay? Now, instead of doing an asset pricing graph, I found actually much more convincing a very simple experiment. Okay. You look at the average currency excess return, again, from low interest rate currency in the first portfolio to high interest rate currency in the last one. This is what you get on average. It only makes sense if you lose money in bad times. If you want to understand why in portfolio number 5 you make money on average, it only makes sense that you need to lose money in bad times. Well, you can just check that. Just look at what happens when you invest in those countries in times of high global volatility. Here I'm looking at 2 standard deviation above, a big shock, right? And what you see is that you're going to lose a lot of money when volatility spikes up. And the difference with the first portfolio, in the first portfolio, you're going to make money in these exact same bad times. So that's really the risk return trade-off. That's the basic thing we teach to all students, undergraduate MBAs and PhDs, right? It's just in action. You make money on average on the last portfolio because you lose money in bad times. On the first portfolio, you lose money on average. Why? Because it's an insurance contract. In bad times, you're going to make money. That's really the logic. Okay? You can see the same thing on a larger sample of both developed and emerging countries. Okay? The risk-return trade-off in action, really finance 101, if you want. Okay? So this, I think, now seems relatively simple and uncontroversial. Of course, it raises many questions. I'm going to go there in a second. But when we started, it was kind of surprising. And so I remember the first paper with Hanno, where our data sets ended in 2002. And so this, in some sense, for us, is out of sample. And for a while, you know, explaining this risk story, it was a bit difficult because people were making a lot of money on the carry trade, the simple investment strategy where you go short the first portfolio and you go long the last one. That's what I'm showing you here on this blue line. These are cumulative returns. When you start with $100 in 2002 and how much money you make over time. And at first, yeah, people were making a lot of money in the carry trade, and that's maybe the only thing they remembered from our work. But then the crisis happened, and they lost everything. And they lost everything exactly at the same time that the equity volatility spiked. And here I'm using really the same measure of equity volatility I told you about, no exchange rate data. And that's the way it should be. It's like this is not surprising in some sense. We don't know when the next crisis happens, but we should expect that in the next crisis, people lose money on risky investments, right? And so guess what? So that's something that we discussed recently with Hanno. It's amusing. I mean, amusing, sad for some people, but it's amusing if you're a researcher, just to look at what happened on the currency markets in this year. We had a spike in volatility on all equity markets, a huge amount of uncertainty in March, in April, and look at what happened on the carry trade. People lost a lot of money. Now, there were also some smart people who actually saw it coming and made a lot of money by just taking the opposite position. But now, if you're just going for the carry trade, you're going to make money on average because you're going to lose money in bad times. Okay, that's the logic. Okay, now one last graph before I stop. I pause, not stop. I want to show you now what Hanno told you about this morning. This idea that we can look not just at the link between exchange rates and short-term interest rates, but also the link between exchange rates and long-term interest rates. So this is one graph that summarizes a paper with Hanno and Andreas, where we look at carry trade returns, thinking about the same holding period. So you borrow for one quarter, you lend your money for 1 quarter, but you can go long and short treasury bills. That's what the first point you're going to see here on the left-hand side of this graph. And if you just play with G10 countries, on average, you're going to make something like a 3.5% return. And since the standard deviation is around 10, the Sharpe ratio is pretty good. But you can think about the same investment strategies, where instead of playing with treasury bill, you can play with long-term bonds. And what I'm showing you on this graph is what happened to the average excess return when you keep the same investment period. So we are still talking about 3 months, But instead of going short and long treasury bills, we are increasing progressively the maturity of the bonds that we are playing with. So in the end, on the right-hand side of the graph, we are playing with long-term bonds, in this case, 15 years. And so what you clearly see is that something is going on. A strategy that was clearly profitable with treasury bill is no longer profitable with long-term bonds. So what's going on? What's going on is exactly what Hanno showed you this morning. When you start playing with long-term bonds, you introduce an additional source of risk. It's interest rate risk. And it turns out that the compensation for this interest rate risk, what we call the term premium, moves in the opposite direction to the currency risk premium. So when you go long and short long-term bonds, you're taking, in foreign countries, you're taking on some currency risk, but also some interest rate risk. And they move in opposite direction, they tend to cancel out each other. So there are interesting things that are going on here on the interaction between risk premia. So the first part of my presentation was to show you that risk premia are there on currency markets. And here, trying to tell you that, you know what, yeah, they are there, but they are complicated objects and they interact with other sources of risk premium. Okay, so that's going to be it. I want to stop very soon, but just to take stock, what was the point of this first part of the presentation? Well, just to tell you that the risk premia are there. We have a clear driver of exchange rates. That's the point that Matteo made. Exchange rates are not random, but as soon as you go there, it actually it means that there are a lot of other questions that we should think about. Okay, so I have after that a series of suggestions, ideas of things that could be done. But before I can tell you what I can be done, I need to tell you, in some sense, what people have done over the last 10 years. A lot of people have looked at other sources of risk and whether they are priced or not in currency markets. So on this slide here, you have just a bunch of examples. And if you think about how you could contribute to this literature, of course, you could go for more. It has to be that we haven't found out yet all the sources of aggregate risk in currency markets. So you could look for more. I think the thing that is at least as exciting and even more maybe is to find the reason for why those risk premia exist, right? And where are the frictions? Are they in the goods market, in the asset trading? We don't really know. And some people have some ideas, and there are some very cool contributions. I'm going to go over there in a second. But there are a lot of opportunities. You can think of this as just the first small step in one direction, saying like exchange rates are not random. We can study exchange rates. There's something to understand there. It doesn't mean that we understood everything. Okay. So maybe let me pause it here. We can stop the recording.